experts, a former Olympian, yeah, not Olympian, it's like hockey, and he's going to talk through the sort of economic outlook. And then once we're sort of all a bit depressed, then we're going to have Steve, who's going to lift us up before a coffee. Is that the right intro? Is that the intro you wanted? Yeah.
Put the hedgehog on.
Yeah, there you go. Right,
is it that way?
Then you got a bit more space to stand.
That way forward. I'll stand. That's fine. Right. Yeah. So I'm Don. I'm a partner at KPMG, and I've had the privilege of working with retailers for the last 30 years or so. And as John said, we do clearly at KPMG we have do a view on AI and how people are using it, how we're helping clients with it. But what John asked me to do was to anchor the conversation in what's happening in the real world. So I'm going to talk about the economy and some stats around retail data in terms of particularly about retail. And then I'm going to just touch on what consumers are actually telling us from their financial data. I've got a 28-year-old daughter, so I do know that there is a complete difference between what people say and what people do. So she will tell me that fast fashion is killing the planet at the same time the doorbell is ringing with her next day sauce and shine parcel. Okay, so what we try to do with the customer data is go, actually, what are people really spending their money on? But let's start with the economy. Essentially, it's pretty stagnant going forward. If I'd done this slide 2 days ago before we released our last quarter's results, it would have been 0.1% lower. So we're going in the right direction, everybody, right? It's gone up a bit. But ultimately, what this says is that it's pretty stagnant. And if you just get a thought around something, which is if GDP growth was tracked from 2019 to now, it would be 2.2%. That's normally quite a good year on its own, and that's been spread over the last 4. Inflation is back under control. That's good news. But then let's work out that if prices had risen at the 2% target of the Bank of England since 2019, then they would have been 13% lower. Okay, so we've had a 13% rise in prices above and beyond because of the inflation stats. So that's not great. However, these are a few more stats. So the good news is wage growth is slightly higher than inflation now, which means that we're starting to make that journey back to feeling like we've got a bit more money in our pocket. Exchange rates look steady and look like they continue to be steady, which I think probably, notwithstanding another black swan event, probably helps people to plan a little bit better. And interest rates have basically got to a point where we think they've peaked and they're going to start to come down. We are not going back to the age of free money. Okay, so I'm sorry to disappoint, but we do think it will come down. Equally, the lag between the interest rates. So only 28% of people in the UK have a mortgage, and of that, 50% of them are on a 5-year fixed, and that percentage has been growing. So the lag on interest rates, in terms of actual impact on probably our largest amount of spend, has happened and is starting to come out. As I was confidently told by my head of consulting and a retail CEO, I said that to you. They were like, "That's great, Don, but I came out in January, and that's not helpful. Thank you very much." So if you have had to refix, you've had to refix at a higher level. But the interest rate story, I think, has peaked and coming down. And unemployment actually is historically low. So that number went up by about, in our view, about 0.2%, but it's historically low. If you want to work in this country, you can work, and that's a completely different debate about whether you want to work or not, and it's a completely different debate about how productively you work and where you choose to work. I understand that, but if you do want to work in this country, you can work, and that is historically low, and we don't think there's a big wave of unemployment coming our way. So in terms of, this is a very fussy slide, but ultimately what it says is we're going to spend about the same amount of money next year as we did this year when we come to consumer spending. There is a gentle shift from retail spending to experience, and that's likely to continue. And what the bit at the bottom starts to talk about is about online penetration. So online penetration had this massive COVID bounce and then retreated for about 29 months in a row, and it's sort of plateaued out. And it's plateaued out by category. And I think that is slightly helpful because I think that gives you a reference point for if you're a perfectly balanced business, where your online penetration rate would be, recognizing that we only are tracking the point of the transaction when we're talking about online penetration. We're not actually tracking the customer journey, because I think we've all realized that actually when we look at our own behavior, we move between the digital and the real world channels in different ways depending on the mission that we're on. So But I do think it's interesting because I do think you get a balance there. That's not to say we won't have digital-only businesses and digital-only models. I think their challenge is how they turn up in the real world. And it doesn't mean that if you've got, there won't be predominantly store-based models. I just don't see Primark, for instance, making a big move into an online transactional web bit. Though I think you can see that they're starting to use the digital channel for things like click and collect, and the same is true of Aldi and Lidl, etc., where it will be very difficult to make that channel profitable. But I think that online penetration bit just gives us a reference point, and it's likely to stabilize and start to creep up. And that is indeed what it did last month. When we look at the retail data in terms of actual spend, it's been pretty anemic, but it's totally been driven by food, and it's been totally driven by price, not by volume. So we've just been spending more on the stuff that we have to spend it on. There have been some resilient categories in there in terms of real world, which have been health and beauty, and they've been value. Now, I recognise when I say that you'll go, and we are definitely seeing differing performances within category. I've just told you value is a resilient category, but we all know Wilko failed. So you can be in a resilient category, but if you're not a good operator, then you're going to fail. And actually, that is something that I think we do need to see a little bit more of, quite frankly, which I don't say with great appetite, but we do need a bit of creative destruction in terms of our retail environment, because that gives the air and the space for people to grow into. Yeah, go. No, they're just the straight numbers. Okay, so this is year-on-year growth, so compared to month-on-month growth. Does that make sense? So that's the point, is that all of those numbers have been pushed up only by price, not by volume. Yeah. Right? So we are buying less stuff, for sure. Yeah. So in volume terms, they'll all be down completely. And in terms of the other bits that start driving it, there's definitely been a return to store post-COVID. And as far as we can see when we look at return to store, it's been more return to retail part than it has been to high street, which is not helpful. But as I said, volumes are still very challenged. And some of the discounts that people are providing to try and drive some behaviour are undermining those price rises that they've tried to push through. I think it is quite interesting, actually, we lost the pricing muscle in this country. So if you go back, actually 20 years ago, we haven't really risen prices in this country as a retailer. So when we got to the point when we had inflation, we had quite a lot of people going, well, how do we do this? Like, what happens if you do this? What I think was interesting when we started having that with our grocery clients, we're like, just go and have a chat with some people in Turkey and Argentina, because they're quite good at it, right? Because they've had it forever. I do think there are some winning strategies in this marketplace, by the way. So there is no doubt that you can grow a smaller business relatively quickly digitally, right? That's still an opportunity. It's how you get from a sort of lifestyle level of scale through to penetrating to really growing a scalable business. At the other end, there is a definite opportunity for scale players, and I think we're seeing that, especially as people start to think about, how do I monetize some of my capabilities rather than just try and sell one more of my bits of product? So what I mean by that is, do I have something that I do better than anybody else? So that might be distribution, or it might be digital marketing, or it might be a customer base that I can monetize that somebody else will pay me for, not because I'm selling another product. Sort of the thinking behind Frasers with Frasers Plus and their ecosystem, and their buying of other brands. It's behind the next total retail platform. It's that level of thinking. I think we'll start to see more and more of that level of thinking. How can I raise money or raise income, not just out of selling my product? Health and beauty still looks like it's resilient, though the luxury end, actually across the board, and the luxury in health and beauty is tougher. And I think that's partly the aspirational bit and the challenge that we've got in our pockets. Ultimately, strong operators win in this marketplace. But then just turning to what the consumers are actually saying. So this is some work we do with Snoop, which is the financial app that screens a bunch of data, as well as a group of people that we ask for their opinion, and then we check it against what they've actually spent. And I think there's some quite stark bits in here. There are 1 in 5 of our population are worried about food. There's about 50% of our population have less than 3 months of income in savings, so it's virtually none. 4 times what people are more likely to save than spend. And 4 in 10 are moving to own brand. And when they move to own brand, what they're actually talking about there is frozen and fresh food, as well as clothing. Though interestingly, 1 in 10 say they'll trade down to own brand, if you trade to own brand, for their pets, which I find a bit weird. So we value our pets more than we value our own children and our own food purchasing. But that's a different point, I suppose. There's also an interesting point in here about the prevalence and rise of buy now, pay later. It's about a 20% increase year on year. And I think that comes with some quite interesting thoughts about how we as retailers or as providers of that decide to do that. I'm a bit caught here because on one side of me, there's a little bit, Hamish will debate this, but I'm a little bit socialist in the fact that I do think it's right that we should give people, as many people as possible, the opportunity to have the assets, products, experiences that they should have that anybody else has, and buy now, pay later does that. On the other side, I go, I can't see any evidence that anybody teaches basic budgeting in schools. So I do worry that we're creating the opportunity for a whole bunch of our society to get themselves into some debt trouble, and that I think is a challenge. I think this, although it's less regulated than maybe it will increasingly become, I suspect this is more a reputational risk than at the moment than it is a legal risk. But I think it is definitely one to be aware of. But ultimately, so the market's not great. The consumer sentiment is not great. I do think it feels a little bit better once we get through the elections and we get some stability. Almost whoever gets in, actually, we just have some certainty of what that might look like, and we'll get a much greater sense of what they are going to want to do, whether that's here, the States, or in Europe, and there's some changes across the world. And I think we're starting to see that in our M&A business, where we've got a lot more businesses having conversations with us about preparing to sell in 25, 26. So ultimately, I think the winners end up being those people who innovate and innovate with appetite, as well as execute really, really in a very disciplined way. I've sort of taken, given it's Wimbledon, with that stat that Roger Federer came out with, which he played 1,265 matches in his career. He won 80% of them. But in those 80%, he won 52% of points. So he lost about 1 in every other point. And I suspect most of the businesses in this room and online at home are going to have a much better success rate than Roger Federer. So I wish you the best of luck.
Thank you.